In the wise words of Jim Dalton, sometimes a market has to break before it can rally, and sometimes a market has to rally before it can break. Let's talk liquidation breaks and short covering rallies. So what are liquidation breaks and short covering rallies? Well, essentially, they can happen in any scenario at any time. So let's say the market is trending higher all day, starting to run out of steam. You might get a liquidation break that very quickly falls, looking for support inside the day's range, and then it finds it and it starts grinding back up, right? Maybe it goes rotational, or maybe it gets continuation higher. You can get a liquidation break on a trend day, but more commonly you get them on a rotational day, right? The market's rotating around, it's trying to make new highs, it's doing its thing, and then out of nowhere, boom, it breaks down, and then it comes right back up into the range. Okay, that is what a liquidation break is. And essentially what's happening is during rotation, you've got a lot of weak hands traders. These are basically people who went long here, here, in here, and in here, right? And they're not getting anything for it. The market keeps pushing up and it's not going anywhere. They're not making any profits. So they're very short-term, weak hands type of traders. So if the market pulls back down and it starts to get below those lows, they instantly panic. They're like, oh no, I got to get out of my trade. So boom, it falls a little bit more. And then more people panic, and boom, it falls a little bit more. And then more people panic. And before you know it, you get this very quick drop. It is very emotional. It is very fast. You can literally see it happening in the charts. The market will be moving at one speed, at one tempo, and then out of nowhere, it just quickly starts to drop, 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 drop. That is a liquidation. So the question that we always ask ourselves, is this going to be just a liquidation break where it rotates down, finds support, and comes right back up into the range? Or is it going to be what we call a liquidation break with new money selling, which would be like it's rotating, it breaks, it tries to come up, can't get back up, and then gets continuation lower? So the question we're always asking ourselves is it a liquidation break, or is it a liquidation break with new money selling? So short covering rally is the same thing as a liquidation break, just to the upside, right? So what happens is you got all these traders that went short up in here, and where are they going to put their stops? They're going to put them above those areas where they went short. And so what happens is when the market gets back up there, if it bursts through, it'll get a pop higher, okay? That is short covering. Boom. All those shorts cover. And then we ask the question, was it just a short covering rally that pulls back down into the range, or was it a short covering rally that has new money buying, giving it continuation higher? So a liquidation break tends to be a lot larger and a lot harsher of a move down, whereas a short covering rally tends to just kind of be a quick little pop that comes right back down, and you kind of instantly find out, are new buyers going to take it higher, or are we just going to rotate back into the range? The reason for that is the psychology of the participants, right? A liquidation break is motivated by fear and panic. All these people that were long need to get out of their trade very, very quickly. And as soon as they see that fast drop, that tempo just start to pick up, they freak out and they instantly want to get out of their trade. Whereas a short covering rally is often more of a technical thing based purely on stops. And to get more people into the trade, it's greed, right? And so this is the old conversation we've had about stairs up, elevator down. To get new people in there using greed, FOMO, the desire to make money, it's just a lot harder to do, whereas fear and panic, you can instantly get them out of their trade. So liquidation break happens very quickly, very harshly, and with a lot of volatility to the downside. But then they take a little bit of effort to kind of grind them back up there into the range. Whereas a short covering rally, it happens very, very quickly and then rotates back down very quickly. And so you kind of instantly get an idea of whether or not you're going to find support. And the range tends to not be quite the same extreme as a liquidation break. It won't go quite as far because, again, it's just based on greed as opposed to based on fear. So with a liquidation break, the way we can tell that it's not going to just rotate right back up, that it's going to be a liquidation break with new money selling is, you'll start to get a lot of volume building up in here, right? The market will have its little moment where it's falling, and then as it starts to trade back up, it'll build volume. You'll get more and more and more volume in here. If you're getting a lot of volume below that low, it's probably sellers looking to take the market lower. It could be support building, and you'll know because it'll get through it and continue higher. But if you're getting resistance and the volume is building and building, it's likely the market needs to take it lower. So basically, that's new people freaking out. The first drop, the liquidation, that was just squeezing out the weak hands from up in here. And then that new pressure, that new volume that starts to build, that new resistance, that's sellers who weren't in a trade getting short, or sellers who got squeezed out of a long, switching positions and getting short. And so that will often lead to downside continuation. If you don't get that, if the market falls and comes right back up and you still have very thin volume within that range, that is a sign all you needed to do was squeeze out the weak hands at the lows, and then the market was ready to rotate right back up because you brought in stronger hands buyers. The basic concept is that the reason that the buyers in a liquidation break are stronger hands buyers is because this is a very scary moment to buy. Trying to buy a liquidation break, it's falling very rapidly. It's very risky to get into it. You have to be able to accept quite a bit of risk because of the range, the amount of volatility that it'll be bouncing up and down. So you just inherently have to be kind of a stronger hand, deeper pocket trader to have the confidence to get that. But then also, if it is just a liquidation break and it rotates right back up, you got in at the lows, you have no reason to exit that trade. The rest of the day, the market will never come close. Even if it just goes back into the range and rotates, it's still never going to come back down towards your entry price. So you can stay in that trade and wait for the market to continue higher. So you just end up becoming a strong hands buyer if you bought down here, as opposed to buying these references throughout the morning where you're likely a weak hands buyer. So that's a really important thing to think about when looking at a liquidation break. And it's exactly the reverse on the upside for a short covering rally. So the question that people obviously all want to know is like, how do I trade a liquidation break, right? How do I trade it? Well, there's lots of different ways. If you catch it early enough, right? If the market starts to drop, you're seeing the tempo pick up, you're seeing that there was a bunch of weak hands in here, particularly if these are like weak references at the lows, you're seeing a lot of weak hands, you think the market's going to liquidate, you can get short with it, but then you want to use a trailing stop because if it is a liquidation break, it can turn around and rotate back up very quickly. So you don't want to be in a short for too long. So you just kind of get short and then you trail your stop on the way down. If you get stopped out, you can look to do it again as like a quick little scalp trade. But what is a more preferable way to trade a liquidation break is to just, when you see it starting to fall like that, you just use that as a mental cue to tell yourself, okay, I can be a strong hands buyer. I can be confident in this. And so when it drops, you see it making a low, it starts to come back up, enter a long trade right there and put your stop below the low. Now you have to just accept whatever that risk is. If it's too many points, if you wait too long to get in the trade and this is too much of a loss for you, do not get into that trade. Because liquidation breaks are unpredictable, they move very quickly, and so you can get stopped out, and then that'll be too much pain for you to experience as a trader, and then you'll never take another liquidation break trade again. So you always want to get in with an amount of risk that you can accept, but you can't use tight stops during a liquidation break. You just can't. You'll get stopped out every time. You're wasting your money. So the only way to really do it is wait till it seems like it's made a low. You don't know. It's liquidating. You have no idea. And then get in at a point where putting your stop below that low is enough risk that if it comes back down and fills, you don't care. You're like, okay, whatever. Get into that trade. Then as the market starts to trade higher, what I often do is I'll add to it. If I start to get the confidence, if the volume stays very, very thin and the market seems to be recovering the liquidation, I'll actually add another contract there on the way back up. And then I'll put my take profits on that first order right up there. So when the market gets back to the base of wherever the break took place, I'll be taking profits on this order and then I'll stay in on this one. And what I'll do at that point is I just move my stop right above there. If it was just a liquidation break, we'll push right back up in the range. And then I'm in a long that has just excellent location where I can stay in that trade and wait for continuation higher. And if it comes back down and it fills my stop, who cares? Didn't lose any money, still made the money on the contract from down here. So that's the way I trade liquidation breaks. It is called catching a falling knife. It is a very risky, difficult thing to do. But what gives you the ability to do it is knowing what you're seeing. The reason so many people out there, so many day traders get eaten alive trying to catch a falling knife on an intraday liquidation is because they're just guessing. They're just randomly getting in. And then when the tempo continues to bounce up and down and up and down and up and down, they freak out and then they end up losing money. So if you have the confidence to know, okay, I'm not getting the volume in here, we are likely to head back up, that'll keep you in that trade and then you can be profitable. As far as trading a short covering rally, if you're totally flat at the moment that the market pops higher, my suggestion is the best trade is always to buy the support on the way back up. So you don't try to short the short covering rally back down. It's just a really hard trade to pull off, and you just won't have any consistency with it. But if you then know, okay, that was a short covering rally, you wait to see what happens when it comes back down. Are new buyers going to step in there? That support is a great buy for continuation. Or if it starts to pull back down in the range, you could short it there to get back to wherever the POC is as a look above and fail. So that's sort of the way to think about a short covering rally is like, I wouldn't try to, the equivalent of catching the falling knife on a liquidation break, I wouldn't try to do that on a short covering rally, but actually the opposite. Wait for a pullback and support. Or if you don't get a pullback, if you get a short covering rally and new buyers step in up here, you could go long with the trend trade, stepping in with those new buyers up there because you see that volume coming in. You know what's happening. That's the way to trade a short covering rally. And here's an example of a liquidation break. So to set the stage, the market's just kind of been rotational all morning, kind of grinding around, going nowhere. Okay, and suddenly the tempo starts to pick up. We start to drop. Out of nowhere, things are moving faster than they were moving before. Market keeps dropping. Tempo's getting even faster. Keeps dropping. Out of nowhere, it breaks the B period low and it just drops like a brick. Look how quickly it's moving. Look how thin the volume is. So we've got super thin volume and the tempo is moving very, very fast. And boom, one more drop. And then just look at how quickly it rotates right back up to the base of that breaking point, which is the B period low. Just like that, instantly back to the low, without bringing in any substantial volume, and they did it very, very quickly. So that is a sign that this was just a liquidation break and that stronger hands probably bought down here, giving it the strength to get back up into range. Let's see how it plays out. Okay, and just like that, we're back at the POC. So it was that first break that told us the message, right? It broke down, it rotated back up very, very quickly without any real resistance, and that was the sign that we just needed to shake out those weak hand buyers, bring in stronger hands, and that's what got us back to the POC. Here's an example of short covering with new money selling. So here we have a rotational day. The market's just been grinding around inside the initial balance all day, creating a few weak references here and there, and just trying to break out to the upside of that initial balance. But they are failing to do so at the moment. So let's play it out and get a sense for how it feels. Okay, so we print a K period. They get a little pullback. Now those buyers who were buying up here looking for the breakout, they're starting to get frustrated. Got a weak K period low, so we know they're weak hand buyers, and they're not getting anything for it. They're trying to push it up there. They're trying to break out to the upside, and they can't get it. And then they start to break below these lows. Speed picks up. You can see the tempo is picking up here. Dropping, dropping. Very, very quickly. The tempo is the key. Very thin volume. An extremely fast tempo. Okay, keeps dropping. Very, very quickly. So they're trying to rotate back up to that A period low. They get there, but they can't get back up in the range. And that brings in new sellers. Okay. They brought in enough volume up here as resistance to turn a candle pink, and the liquidation continues. Okay, and the market is closed. So what happened there, right? Let's just replay it. Let's just walk through very quickly what happened. So they were rotating all day. They were creating weak references on the way up. They created multiple weak references up here, trying to get higher. They come back down. They create another weak reference at the K period low, bounce off of that a few times. And then as soon as they start to drift below these lows, it started right at that H period low. As soon as they started to pull below there, the tempo picked up, and very quickly we fell down here to the L period low. They brought it back up and tried to get back up into the range, but they couldn't really get in there. Come back down again, building up more volume. The shorts are building and building. M period tries to get up in there, can't quite get it, and then boom, we drop like a brick. On the way down, we get the confirmation with the pink candles that there are new sellers, new business trying to take us lower, and they were successful. That is a classic liquidation break with new money selling. Why did it happen? Because of all the weak hands that bought in here. When the market started to get back down below their entries, they just got squeezed very quickly. And that is what you would expect. And here's an example that is a lot more complicated, where we did get new money selling, but it faked us out first. Let's take a look. So here we've got a day that was rotational, right? It started trending higher, then we got a cessation of one time framing. We rotated down, broke out of rotation, and then we've just been kind of grinding around here for the last few hours, trying to get back up into range, trying to get back to where we were rotating earlier on in the morning, but we're getting resistance, right? So the buyers are getting frustrated. They keep trying to get the market higher and they can't get it. They can't get it. So we've got a poor low now in the K period, which is in need of repair. So we got to get a couple ticks below, and that's going to start a liquidation. So what you're going to see happen is, obviously I'm playing this sped up, but you'll still be able to tell tempo-wise that it drops very, very quickly. Okay, it'll just drop like a brick very, very quickly, and then its attempt to try to get back higher will be very, very hard. Now, eventually, at some point, they will get it back up there. Just notice what a hard time they have trying to get it up there. The buyers are trying to push it. They can't get it, so boom, it starts to fall. Pushes back up to that H period low resistance. Boom, another fall. Boom, boom. Boom. Just keeps falling, right? That's what a liquidation break looks like. Just falls and falls. Okay, so now the buyers are starting to step in. Okay, they're trying to save the market. The way we measure the success is if they can immediately trade back up to where it broke, to that H period low. So you can see more sellers coming in, pushing it lower, pushing it lower. Okay, so this is where it gets interesting. Now, normally with a liquidation break, if the market can pull its way back up to the place where it broke without creating any pink candles down here, it is a sign that we didn't have enough sellers to get continuation lower. Normally, this would be what the market needs to get a push higher, right? Normally, you get the strong hands that come in here, and they're enough to push the market higher. But watch what happens when the market tries to get higher here. Can't do it. Can't get up into the range. So that brings in a second liquidation. Now all these strong hands buyers from before, they start to give up. Boom. Market begins to liquidate once again. Falls. Falls. So then we close down here at lower prices, okay? So in this example, the first liquidation break was able to retrace, and that should have been enough strength to get us back up to the POC, but it wasn't. And that was a signal that these weren't strong enough buyers in here, and we needed one more liquidation break. So the liquidation break was happening when we got the M period. We closed down here. And then in the first few minutes of the overnight, we immediately retraced it, just like that. So it was a liquidation break. It was just timing-wise, it was at the end of the day. So we can see the first liquidation wasn't enough to bring in strong hands. We traded back up, but we couldn't get to the POC, so we had a second liquidation. The market happened to close down here while we were liquidating, but then immediately, as soon as the market closed, we rotated back up to that POC because it was the second liquidation break that brought in the strong hands. Okay, so let's take a look at an example of a short covering rally. Right here today, we had an initial balance to the upside. We started one time framing higher in the C period, but then immediately got cessation of that trend in the D period. And since then, the market has just been going sideways. It's just been rotational. So our assumption is that we're going to continue to rotate around inside today's range. So we've got some weak hands in the E period shorting up in here as it is exactly at that B period high. And now we're in the F period. So let's watch how it plays out. Okay, we got another weak reference on the F period high, so more weak hands piling on there. Still weak, only one tick above the D period, more weak hands, and then boom. Okay, so now they're starting to get squeezed. Those stops are starting to fill. The shorts, the weak hand shorts in here are starting to get nervous. Boom, more of them exiting the trade. We print the G period, backfill single prints. Okay, so now we're starting to find support. So it's still just a short covering rally, but there is potential for new buyers stepping in. And what we're watching is the volume. Do we start to get some substantial volume here above the D period high? And they are bringing it in. We can see the node getting bigger and bigger here. They're bringing in volume above the high. There's our pink candle. That is confirmation that there are more buyers stepping in up here at higher prices. Now it once again tries to pull back down into the range and does not. That is further confirmation that the market is trying to trend higher. If not, it would have very easily pulled back down into the range pretty quickly, right? The more time that we spend up here now and the more volume that we bring in, the more it increases the odds that this is a short covering rally with new money buying. Adding on to it. And then you can see it just continues to trade higher from there. So you can see right now in this moment, if you'd have bought, so you got the push higher, you started to bring in the pink volume, then you came back down and tested this high again. If you'd have bought it when it started to push higher, you'd already have that much profit in your trade. You can move your stop above entry and just kind of wait it out. Further confirmation, all this volume up here, we are breaking out to the upside. So that is a short covering rally. Well, that's it for liquidation breaks and short covering rallies. Thank you so much for watching, and we'll see you on the next lesson.